The date is January 11th, 2026. This briefing addresses a milestone that was, until recently, dismissed as a distant mathematical tail risk. As of this morning, the United States national debt has reached a verified $38.4 trillion. While the headline number is staggering, the number that actually dictates the survival of the global credit system is the one found in the latest Congressional Budget Office, or CBO, projections. Here is the hard receipt. The CBO has confirmed that for the first time in history, the annual net interest cost on this debt has officially crossed the $1 trillion threshold. To put this in a measurable narrative context, that means roughly 20 cents of every single tax dollar collected by the Treasury is now absorbed by interest service. Before a single dollar is spent on infrastructure, defense, or social services, we have moved past the era of cheap credit and entered the era of the refinancing treadmill. This is the opening of stage 3 in what we call the reserve currency cycle. Historically, a reserve currency's decline is not marked by a sudden cinematic explosion, but by a silent exodus. This is a period where the global official sector, central banks and sovereign wealth funds, stops viewing the dollar as a risk-free asset and begins viewing it as a source of duration risk. You will not see this exodus discussed in sensationalist terms on the nightly news. Instead, it is visible in the deteriorating marginal financing conditions within the Treasury market. The issue we face in 2026 is not simply the size of the debt stock, it is the rollover behavior of the debt. When the CBO projects interest costs exceeding the defense budget, the world takes notice. The silent exodus refers to the subtle, systematic shift of capital away from the dollar-denominated ledger and toward tangible settlement. The global credit system relies on a simple assumption that there will always be a buyer of last resort for U.S. debt. However, as the interest-to-revenue ratio tightens, that assumption is being tested. We are witnessing a divergence between what the public is told about economic resilience and what the institutional data tells us about systemic solvency. When interest payments reach $1 trillion a year, the math becomes the primary macro constraint. This is roughly $2.7 billion in interest being generated every 24 hours. It is a burn rate that traditional fiscal policy is not designed to extinguish. In this environment, the official sector begins to prioritize physical settlement over digital promises. Most people are looking for a crash. They are looking at the wrong signals. The real signal is the change in how the world's largest holders of capital are repositioning their balance sheets to avoid the duration trap of a currency in stage 3 of its cycle. They are not waiting for a collapse. They are quietly leaving through the back door while the lights are still on. To understand where this capital is moving, we must look at the ledger of departure, the actual flow of capital that the public rarely sees. Here's the part most people miss. The exodus is already visible in the official data, if you know where to look. To identify the mechanics of a silent exodus, one must look past the domestic political theater and into the Treasury International Capital Reports, the TIC flows. These documents represent the ledger of global confidence. They track exactly who is buying, who is selling, and most importantly, what kind of debt they are willing to hold. Here's the hard receipt. The latest TIC data shows a historic divergence that the mainstream financial press has largely overlooked. While total foreign holdings of U.S. Treasuries appear stable on a nominal basis, the composition of those holdings has shifted. The official sector, meaning foreign central banks and sovereign wealth funds, has become a net seller of long-term Treasury bonds for the third consecutive quarter. In their place, private sector buyers, often leveraged hedge funds operating through offshore centers like the Cayman Islands, have stepped in to fill the gap. In institutional terms, we are witnessing a global rejection of duration risk. Foreign central banks are no longer willing to lock in capital for 10, 20, or 30 years at current yields, while the U.S. fiscal deficit continues to expand at its current trajectory. They are moving their capital to the short end of the curve. Treasury bills that mature in months, not years, are exiting the paper market entirely. This is a critical signal in the reserve currency cycle. It indicates that the dollar is losing its status as a hold-and-forget asset for the world's largest creditors. The result of this shift is a tightening of marginal financing conditions. When the world's most stable buyers retreat, the burden of funding the $38.4 trillion debt falls onto the primary dealers, the large domestic banks that are legally required to bid at Treasury auctions. Here's the part most people miss. The primary dealers are not buying these bonds because they are an attractive investment. They are buying them because they are the liquidity backstop of the system. We are seeing a transition from global recycling, where the world sent its trade surpluses back into U.S. debt, to internalized financing. In simpler terms, the system is now being forced to consume its own tail. To understand the scale of this, consider the spoken math of the current auction cycle. The Treasury must now issue nearly twice the volume of debt just to pay off the maturing bonds from previous years. This is the rollover. If foreign appetite continues to wane, the interest rate required to attract private buyers must rise, which in turn increases the $1 trillion interest bill we discussed in the previous chapter. It is a closed loop of escalating costs. Historically, when a reserve currency enters stage 3, the official sector begins to prioritize physical settlement and hard assets over digital ledger entries. They stop recycling their trade surpluses into the debtors' bonds and start looking for an exit that doesn't trigger a market panic. They are not dumping their holdings all at once. They are simply refusing to participate in the next round of financing. This divergence between the official sector and private speculators is the quiet signal that the structural foundation of the global credit system is shifting. However, if you were to listen to the official reports from the financial capitals, you would hear a very different story. To understand why the public remains unaware of this exodus, we must examine the gap between the data and the headline narrative. In the world of institutional finance, there's a distinct wall between public-facing rhetoric and internal data. While the silent exodus accelerates in the bond market, the prevailing headline narrative remains one of economic resilience. The public is told that the consumer is robust, the soft landing has been achieved, and the global credit system has successfully absorbed the shocks of the last 5 years. However, when we analyze the Federal Reserve's H8 report, which tracks the assets and liabilities of commercial banks in the U.S., a different, more fragile picture emerges. Here is the hard receipt. The latest H8 release indicates that commercial bank credit has entered a period of structural stagnation. For the first time in the current cycle, we are seeing a year-over-year contraction in real estate loans and commercial and industrial, or C&I, lending. While the headline GDP might look stable, the underlying marginal financing conditions for the real economy are tightening. This isn't just a slowdown, it is a fundamental shift in how capital is being deployed. Banks are no longer aggressively lending to the private sector. Instead, they are repositioning their balance sheets toward high-quality liquid assets, which is institutional code for government-backed paper. The issue is that as the national debt hits $38.4 trillion, the quality of that liquid asset is being questioned by the official sector abroad, even as domestic banks are forced to hold more of it to maintain their capital ratios. This creates what we call the liquidity backstop illusion. The narrative suggests that the Federal Reserve can always step in to provide liquidity if the gears of the system grind to a halt. But this overlooks the macro constraint of the reserve currency cycle. In previous decades, the Fed could expand its balance sheet without immediate consequence because the rest of the world was hungry for dollars. Today, every new dollar created to save the system adds to the duration risk that is driving foreign creditors away. Here's the part most people miss. The soft landing narrative is a psychological tool designed to maintain domestic confidence while the structural plumbing is being rerouted. If the public realized that interest payments were consuming 20 cents of every tax dollar, the velocity of money would shift from investment to preservation. By maintaining a headline of stability, the official sector buys time to manage what is effectively a controlled deleveraging. We see this gap between rhetoric and reality in the duration risk management of the major primary dealers. While the media focuses on the next interest rate decision, the institutional players are watching the refinancing treadmill. They know that the cost of servicing the debt is now higher than the growth of the economy itself. In spoken terms, the country is now borrowing money just to pay the interest on the money it already borrowed. This is the definition of a debt trap. Historically, when a system enters this phase, the gap between the official narrative and the data receipts continues to widen until a liquidity shock forces a reset. The public sees a calm surface, but the H8 data reveals the cooling of the engines underneath. The silent exodus isn't just about foreign countries leaving the dollar, it's about the domestic credit system losing the ability to fuel growth. To understand why this gap is appearing now, we must look backward. This isn't a modern anomaly. It is the predictable third stage of a cycle that has repeated for centuries. The challenges we face in 2026 are often presented as unique modern crises, but to the institutional eye, they are the predictable symptoms of a maturing reserve currency cycle. History provides a clear map. From the Spanish real in the 17th century to the British pound sterling in the 20th, every global reserve currency undergoes a four-stage evolution. We have moved through the era of industrial dominance, stage 1, and commercial hegemony, stage 2. We have now firmly entered stage 3, the global debtor phase. In this stage, the hegemon no longer exports goods to the world, it exports its debt. The currency's value is no longer maintained by a surplus of trade, but by the world's lack of an immediate alternative. However, this reliance on the lack of an alternative is a fragile foundation. Here's the hard receipt. According to the latest IMF COFR, the composition of foreign exchange reserves, the US dollar's share of global reserves has slipped to its lowest level since the end of the Second World War. While it remains the primary medium of exchange, the official sector has quietly begun diversifying into a basket of non-traditional currencies and, more importantly, hard assets. This isn't a speculative theory. It is a measurable trend reported by the world's central banks to the IMF. This transition mirrors the decline of the British pound. In the early 20th century, London remained the world's financial capital, but the underlying economy had become a net debtor to the United States. Britain was forced to maintain high interest rates to attract the capital necessary to service its debts, which in turn stifled its domestic growth. The U.S. is currently caught in this exact Stage 3 trap. We must keep marginal financing conditions attractive enough for foreign creditors to stay, yet those very conditions are becoming a macro constraint on our own economic stability. The silent exodus is the process of the world preparing for the end of this cycle. When a currency enters Stage 3, it faces what economists call the Triffin dilemma. To provide the world with liquidity, the reserve issuer must run constant deficits. But those very deficits eventually undermine the confidence in the currency itself. In 2026, with a $38.4 trillion debt and an interest bill of $1 trillion, the dilemma has reached its breaking point. Historically, the shift from Stage 3 to Stage 4, the loss of reserve status, is triggered when the cost of servicing the debt exceeds the ability of the official sector to keep the system liquid. The IMF COFR data is the early warning system. It shows that the world is no longer just talking about de-dollarization. They are actively reallocating the ledger. Here's the part most people miss. Stage 3 can last for years, but it is characterized by a hollowed-out economy. The financial markets remain large and liquid in name, but they lose their connection to physical reality. The system becomes a refinancing treadmill, where every new dollar created is immediately absorbed by the need to roll over existing obligations. This is the historical framework that explains why the TIC flows are diverging, and why the H8 bank data is stagnating. We are not just in a high interest rate environment, we are in the final stages of a 300-year-old cycle. The silent exodus is simply the global market's way of pricing in the inevitable conclusion. To understand the speed of this transition, we must look at the refinancing treadmill itself, the actual mechanics of how $38 trillion in debt is serviced in real time. The stability of a reserve currency is not measured by its total debt, but by its ability to refinance that debt without triggering a liquidity shock. As we enter the second week of 2026, the United States has reached what institutional analysts call the maturity wall. The issue is no longer just the $38.4 trillion in total obligations. It is the sheer volume of paper that must be rolled over at current market yields. Here's the hard receipt. According to the latest Treasury maturity schedules, approximately $9 trillion of marketable U.S. debt will mature and require refinancing within the next 12 months. This is a massive increase in refinancing requirements compared to the previous decade, primarily due to the surge in short-term borrowing used to fund recent deficits. When you combine this $9 trillion rollover with the projected $2 trillion deficit for 2026, the Treasury is forced to auction roughly $11 trillion in new securities this year. To put this in a spoken narrative context, the government must find buyers for approximately $30 billion of debt every single day, including weekends and holidays, just to keep the lights on and the old debts paid. This is the refinancing treadmill in its most aggressive form. Historically, the Federal Reserve provided a liquidity backstop for these auctions. However, the latest Federal Reserve H4 1 report, which tracks the central bank's balance sheet, reveals that the traditional buffers are nearly exhausted. Receipt 2. As of January 7, 2026, the Overnight Reverse Repurchase Facility, or RRP, has plunged to a mere $20 billion, down from over $2 trillion just 2 years ago. For years, this facility acted as a massive pool of spare liquidity that could be drained to absorb new Treasury issuance. That pool is now effectively dry. Furthermore, H4.1 data shows that reserve balances held by banks have declined to $2.99 trillion, a level that historically signals the threshold of scarcity for the private banking system. As the RRP buffer disappears, the burden of maintaining marginal financing conditions falls squarely on the private market and the primary dealers. Without that secondary pool of liquidity, every new auction risks a failed bid or a spike in yields that would further accelerate the interest burn rate. We are currently seeing the spoken math of this trap in real time. The U.S. is now paying approximately $2.7 billion in interest every 24 hours. This interest expense is now the second largest line item in the federal budget, outstripping national defense and every social program except Social Security. In institutional terms, this is a crowding out event. The government's need for cash is so great that it is sucking the oxygen out of the private credit markets. This is why the official sector abroad is watching the H41 report with such intensity. They know that when the RRP hits zero and bank reserves tighten, the Fed faces a binary choice. Either allow interest rates to rise to a level that bankrupts the Treasury, or resume large-scale physical settlement and monetization to keep the treadmill turning. The silent exodus is the reaction to this reality. Sophisticated capital knows that a system requiring $11 trillion in annual refinancing, while its liquidity buffers are empty, is a system approaching a regime change. The treadmill is moving faster, but the floor is beginning to give way. In the world of institutional intelligence, we do not deal in prophecy. We deal in probability. The silent exodus and the tightening of marginal financing conditions lead to three distinct paths. Each depends on how the official sector reacts to the current $38.4 trillion debt burden and the exhaustion of liquidity buffers we analyzed in the previous chapter. Scenario 1, the base case, the slow grind. In this scenario, we assume no immediate systemic shock. Instead, the refinancing treadmill continues to accelerate. The Treasury and the Federal Reserve manage to keep auctions moving by allowing inflation to remain sticky at 3 to 4%. This is effectively a soft default, a process of financial repression, where the value of the debt is slowly eroded while interest rates are kept just below the rate of inflation. Under this path, the dollar does not collapse overnight. It simply continues its slide in the IMF COFA rankings. For the average investor, this looks like a decade of stagnant real returns and a steady rise in the cost of living as the reserve currency cycle enters its late-stage decay. Scenario 2, the stress case, the liquidity shock. This path is triggered if the official sector abroad accelerates its exit. Historically, when foreign net purchases of treasuries drop below a critical threshold, as the TIC flows currently suggest they might, the primary dealers become overwhelmed. This leads to a funding stress event, a spike in the overnight repo rate, or a failed treasury auction. If this occurs, the Federal Reserve would be forced to abandon its inflation fight and intervene as the liquidity backstop of last resort. We would likely see the implementation of yield curve control, where the Fed caps interest rates by printing the difference. While this saves the government from immediate insolvency, it signals to the global market that the dollar is no longer a market-driven currency, but a politically managed one. Scenario 3, the regime change, the multipolar reset. This is the most transformative path. Under this scenario, the current global credit system transitions into a multipolar reserve environment. As the macro constraint of the debt becomes undeniable, the world's major economies, including those in the BRICS Plus bloc, formalize a new settlement system backed by hard assets rather than digital credit. The dollar remains a regional currency, but it loses its exorbitant privilege as the global unit of account. In this case, the shift from stage 3 to stage 4 of the reserve currency cycle is completed. We move from a world of infinite credit to a world of physical settlement. Here's the part most people miss. These scenarios are not mutually exclusive. We can experience the slow grind until a liquidity shock forces a regime change. The common denominator across all three paths is the increasing cost of duration risk and the declining utility of purely digital fiat. Under a higher rate path, the system eventually reaches a point where the interest expense cannot be covered by tax revenue or new debt issuance. Historically, when this threshold is crossed, the physical truth of the market asserts itself. This brings us to the final and perhaps most critical realization. If the digital ledger can no longer be balanced, the only remaining solution is the move toward assets that carry no counterparty risk. The exodus is silent because the participants are moving toward a tangible exit. To understand what that exit looks like, we must look at the final physical constraint. We have reached the final stage of our briefing. We have tracked the $38.4 trillion debt, the $1 trillion interest bill, and the silent exodus, visible in the TIC flows and IMF COFA data. But all of these numbers exist in a digital ledger, a world of accounting entries and sovereign promises. The ultimate macro constraint is not a lack of digital currency. It is the limitation of the physical world. Here is the hard receipt. While the global credit system has expanded by trillions of dollars in the last decade, the physical supply of Tier 1 monetary assets has remained historically constrained. Specifically, in the silver market, we are entering the fourth consecutive year of a structural deficit. According to industry data, the gap between annual silver production and industrial plus investment demand has reached hundreds of millions of ounces. This is where the refinancing treadmill hits a wall. In a system of infinite credit, you can always print more currency to pay the interest on the debt, but you cannot print more silver to settle a trade or back a currency. As marginal financing conditions continue to tighten, the official sector and sophisticated private capital are moving toward what we call counterparty-free assets. They are moving away from the IOU of a debtor nation and toward physical settlement. Consider the spoken math of this divergence. If only 1% of the $38 trillion in the U.S. debt attempted to rotate into the physical silver market, it would represent a capital wave larger than the entire global supply of the metal currently in existence. The digital ledger has grown so large that the physical truth can no longer support it. Historically, when a reserve currency enters stage 4 of the reserve currency cycle, the transition is marked by a flight to quality. But in 2026, quality is being redefined. It is no longer just about the credit rating of a nation. It is about the physical deliverability of the asset. The silent exodus is not just a move out of the dollar. It is a move out of the entire concept of unbacked duration risk. Here's the part most people miss. The silver and gold markets are the canaries in the coal mine for the global credit system. When central banks begin accumulating hard assets while selling their treasury holdings, as the COFIR data suggests, they are preparing for a world where digital trust is no longer the primary currency. They are preparing for a physical reset. The cliffhanger we face is a tangible one. We are watching a race between the speed of the refinancing treadmill and the exhaustion of physical inventories. The system can survive $38 trillion in debt as long as the world accepts digital promises as payment. But the moment the official sector demands physical settlement, the illusion of the digital ledger evaporates. The silent exodus is nearing its conclusion. The capital has been repositioned. The receipts have been filed. The only question remaining is what happens when the next Treasury auction occurs, and the world finds that the liquidity backstop is empty, and the only thing left of value is what you can physically hold. In our next briefing, we will examine the specific trigger events in the silver market that indicate the physical transition has begun. Because in a world of $38 trillion in debt, the truth is no longer found in the spreadsheet. It is found in the vault.